So I'd like to firstly thank Louisa for joining us today. Very, very much appreciated. I've been working with Louisa for a long while on this, as I said, and I think I need to not talk because Louisa is going to be saying all the really interesting stuff. And with that, I will say over to you. Thank you.
Thank you very much for the invitation and really nice introduction, Julia. It's great to be here, great to see such a varied audience and great location as well. So thank you very much to everyone at SRI for organising the event. I think it'd be quite hard to follow such a really good panel on SDR just before. It was a really interesting discussion, really interesting debate. But what I will do is try to take a step back and give a broader outlook, overview, and set out where we are in terms of the broader sustainable investment landscape. So not just SDR, but I will look at how the sustainable investment landscape has progressed over time from a regulatory perspective. And I'll aim to do three things. I will zoom out, as I said, beyond SDR. So how is the FCA approaching sustainable finance more broadly? I will, of course, take the opportunity to zoom in to SDR and pick up on some of the points that the panel has just raised and you all through your questions as well, but also take a step back and really set out what this means, what you're seeing, and how you can approach it going forward. And then I will give a brief look ahead at what's coming up and what you might want to look out for from a regulatory perspective. So I hope that will leave you with a clearer overview of what we're doing at the FCA, but I know you will have some questions, so very happy to take some questions perhaps at the end, or would you prefer? Perhaps at the end, if that's okay, and then feel free to come and find me in the breaks as well, or even contact me after if you don't manage to share your question here. So first, zooming out onto the broader FCA's work and what we're doing. Let me start with a simple premise, which I think was very much covered in Julia's remarks, and that is that climate and sustainability risks and opportunities are very much financial risks and opportunities. We have unfortunately seen an increase in weather events like flooding, even here in the UK, which will put strain on sectors such as insurance. It may therefore lead to people not being able to get a mortgage. We've seen the economic impact on the slide that Julia had up. These really are financial risks and opportunities, and that is our starting point for everything we do. We ground everything in those risks and opportunities in line with the FCA's objectives. So where there is consumer protection risks or market integrity risks or competition risks, we will step in. Another premise, and this was also touched on, I think, in Julia's remarks, sorry, I'm just repeating everything that you said, is that clients care. Julia mentioned our Financial Lives survey, which has shown again that a significant number of adults surveyed, about 7 out of 10 in the latest Financial Lives survey, really do want their money to do some good as well as receiving a return as well. So that's what we're doing. That's why we're doing what we're doing. We want to support you, and we want to support clients and consumers to be able to have information that they can trust, that they can rely on, and ultimately support those investment decisions. So, as I said, I won't just focus on SDR, looking a bit broader and zooming out a bit more on what we're doing, particularly in the Sustainable Finance Policy team, but across our division as well. I'll start with corporate disclosures. These are key. These are a core source of information and data that you will need across the ecosystem. So what we focus on is trying to ensure that those disclosures, that corporate information, is high quality, it is consistent, and it is reliable for you to use in your products and in conversations with clients, and also perhaps in ESG ratings, which I'll come on to later as well. I think kind of things progressing and moving on has already become a bit of a theme in the morning so far, and that's what we have felt with corporate disclosures as well. We needed to start somewhere, so the initial rules that we made for listed companies was based on the TCFD recommendations, and that applied across the economy as well. But corporates have been disclosing against TCFD for at least 3 years in line with our rules, and maybe even longer before if they were disclosing voluntarily. And things have moved on, things have progressed since then. We now have the International Sustainability Standards Board standards, so that's the ISSB standards, which set a global baseline for sustainability information. So you may have seen that the government has consulted on incorporating those international standards into the UK, or endorsing them, and they will be known as UK Sustainability Reporting Standards, or UK SRS. And what we intend to do at the FCA is to consult on moving and progressing from our TCFD-aligned rules for listed companies to those ISSB standards, or UK SRS as they'll be known as, so that the information that our listed companies are disclosing is in line with those global standards. So that should support that greater consistency of information and reliability and comparability as well overall. I should also say that transition plans are a key part of the information that you use for your decision making as well. Transition plan just does what it says on the tin. It is a company's plan for how it intends to transition to a more sustainable future. And you may see information such as what the strategic ambition is for the company, what the actions are, and how they will remain accountable. For those of you that are familiar with the Transition Plan Task Force, you'll recognise those as the key principles of the Transition Plans Task Force disclosure framework. And we very much supported that government-led or government-established task force and market-led task force to develop best practice for transition plans. So as part of our consultation on moving from TCFD to ISSB for listed companies, will also include proposals on transition plan disclosures as well. I think what I will say is that it is not all about disclosures. I think hopefully you'll be happy to hear that it's not all about disclosures. There is broader work going on to explore how firms are taking into account and looking at climate and sustainability risks and opportunities more broadly. And transition finance is a good example of that. We have work underway to really explore how firms are thinking about transition finance and how they might want to leverage the opportunities that transition actually might bring. We're doing that in a number of ways. We supported the Transition Finance Market Review, and we're now observers of the Transition Finance Council. We have also started a pilot with the PRA and the Green Finance Institute, and what we're really looking to do is to engage with you all, to engage with the market, and really explore the practical matters that are taken into consideration when thinking about scaling transition finance. So we will keep you updated on that work and hopefully be able to update you in due course. Another key area, I think I mentioned some of the weather events and the more physical risks of climate change. We are also looking at how those physical risks impact the market and what our role might be in supporting the market to address those risks, given the implications, as I said, for sectors like insurance and mortgage. So we are engaging with public bodies, we're engaging with industry, for example, through the Climate Financial Risk Forum and their adaptation working group. And again, we will say more when we can. So all of this work, everything that we're doing is to give you that trust, that transparency in the markets, to build that integrity of the markets, to protect consumers, and hopefully to support you all in your own conversations and in your own decision making as you support your clients and consumers as well. But of course, so I've zoomed out quite a bit, but it is now time, I think, to zoom in to SDR and just give some reflections on where we are on the panel's conversation and kind of what that really means for you. So taking a step back, we introduced the regime, as I think has already been covered, to help consumers, really. I think we had a member of the audience who said that the regime really is for retail consumers, to really help them to navigate a market which was quite complex, and to help give them better information, to help them to make better informed decisions, and to reduce and minimise greenwashing, and ultimately to build their trust in this space. I think just building on some of the panel's initial reflections, SDR does raise the bar, and it was intended to raise the bar, but in doing so, there certainly were some challenges along the way, and it certainly was it took a longer time for the regime to really bed in and to really kind of lift off. And we definitely appreciate that it's new, it raised the bar, it's different, and more support was needed along the way. So I think the good and poor practice examples were mentioned. We put some out last year. We will continue to listen and to put out some more good and poor practice examples, and to continue to support implementation. I think one of the other points raised was the kind of number of labels, and I think Julia's slide also showed that disparity between the number of funds using labels and the number of funds with sustainability characteristics that aren't using labels. So one thing that I do just want to clarify is that the regime was never always about labels. Labels are doing something very specific. They are very much for funds that have a positive, or they're seeking to achieve a positive sustainability outcome, and that have a specific sustainability objective that the fund is remaining accountable to, and then and obviously meeting the other criteria that flows from that objective. We very much recognise that there are lots of other funds with sustainability characteristics that might not want to, or that just might not be able to, given the investment approach, actually stand by a specific sustainability objective. And that's why we also introduced the naming and marketing rules, so consumers can have a choice. So they might not want to invest in a labelled fund, they might want to invest in a fund with sustainability characteristics. For both types of needs and preferences, there will still be consumer-facing disclosures which set out the key sustainability characteristics of those funds. For a labelled fund, they'll say if the fund has an objective and what that objective is and the investment approach. And for a non-labelled fund, they'll give consumers the information as to why the fund doesn't have a label and what the sustainability approach is nevertheless, so that the consumer can make the decision about what they want to invest in. So all about consumer choice. We are pleased to hear that at least there have been some positives out of the rigorous and challenging process, and that it has started to help articulate the investment approach slightly clearer and more consistently for consumers as well. So that glad to hear that there are some positives, but I think we appreciate that there is still a way to go, and we are still here to listen to feedback, and we're still here very much to explore and monitor the market and explore what we can do to make this regime work for you all and for our consumers. So I will just point out a couple of things that you've probably noticed already, but just some nuances about the regime. So I think firstly, as I've just mentioned, building on the panel's discussion, is that labels aren't for every product. They are only for products with sustainability goals, and I think the key message that I do want to reinforce is that it is not all about labels, and the non-labelled side of the market should very much still be discussed with clients. The information should still be given to clients, and it's up to them to make their own decisions. I think the second thing that I'll draw out that you might have noticed is that you might see some differences in the information that's disclosed in those consumer-facing disclosures and other disclosures, and that is very much intentional. We set out the types of information that you'll see. So, for example, the sustainability objective, the investment approach, metrics. But what we didn't do is prescribe the specific metrics that will need to be disclosed. And we didn't prescribe a taxonomy or a specific standard. What's most important is that firms have the ability to tell the story of their fund. And I think, as panelists said as well, every fund will be doing something slightly different. So it's about really articulating what that specific fund's outcome is, what it's trying to achieve, and how it intends to get there. And then I will also draw out some of the differences that you'll probably see in terms of the types of labels that, types of funds that can use labels, and I think this was very much discussed on the panel as well. We introduced SDR and labelling as a regime that is intended to increase trust over the sustainable investment landscape, but we did start with one portion of the market, and that's UK domiciled funds, with a view to expand and extend the regime over time. So there was a lot of talk about overseas funds. We see overseas funds in the regime, but the UK Treasury, HM Treasury, are responsible for market access. So they will need to consult on expanding SDR to overseas funds first. So that is a matter for Treasury. We continue to engage with them, but don't have information on what the timing of that potential consultation would be. I think separately, we heard a lot about portfolio management on the panel just now. We had consulted on extending the regime to portfolio managers. That consultation was out last year, and earlier this year we put out a statement to clarify that we are pausing the finalisation of those rules for now. And I will reiterate that it is a pause, it's not a stop. We got a lot of positive feedback from that consultation, but we also heard feedback that firms wanted the regime for UK funds to bed in first, and for greater clarity on overseas funds first as well. So we are listening to that feedback, and we want to ensure that the time is right and that portfolio managers can have a regime that is workable for them, I think, as Julia also said. But very much appreciate that there are a lot of portfolios that will be investing in funds with labels, funds without labels, overseas funds, business as usual. So I do just want to clarify what that kind of pause means for you. It means that you can continue to use sustainability terms like sustainable, impact, that there are no restrictions. What there is the anti-greenwashing rule, which requires that any use of those terms, any sustainability claims are fair, clear, and not misleading, and consistent with sustainability characteristics. And we published non-handbook guidance which sets out some more clarity around what that means. So those claims must be clear, comparable, capable of being substantiated, etc. And we publish some good and poor practice examples to help bring some of that to life as well. It does mean that portfolios can't use labels for the actual portfolio itself. There is an explicit rule that says that only funds in scope of the regime can use labels, so portfolios can't use labels at the moment, but it also means that portfolios don't have to meet any of the other requirements, so don't have to produce disclosures, consumer-facing disclosures, detailed disclosures. None of that applies at the moment. It's simply just the anti-greenwashing rule. So that's portfolios. I think just turning to advisors and what this means for advisors. I think even though the regime was designed for retail investors in mind, most of what the regime is intended to do should really support advisors in their fact-finding and client discussions as well. So similarly, helping you to navigate the market, giving you better information, the consumer-facing disclosures being short, simple, snappy disclosures that should give you a summary of sustainability information, reducing greenwashing, etc. But there are some asks as well. There are some requirements, such as actually communicating the labels to clients through your usual channels of communication, communicating the consumer-facing disclosures, and as I said, not just for the labelled funds, but very much for the non-labelled funds as well, so that consumers can make their own decisions. And where in scope of the anti-greenwashing rule, consumer duty, it's applying those as appropriate. And I will also add to look out for the report that Julia mentioned, the advisors from this Advisors Sustainability Group. That group was established specifically to help build capabilities and build on capabilities for the advisor community. So very much thank Julia and others in the audience, I think, who have contributed to that group, and look forward to the outputs. So I will leave it there in terms of the zoom in. Just a really quick overview of what's next. So as I mentioned, the UK SRS consultation, which we intend to publish shortly. We are also working on ESG ratings, so you may be aware that the UK government intends to bring the ESG ratings providers into the FCA's perimeter, and once it finalises its legislation, we will then be able to consult on what that regime will look like for ESG ratings providers. We want it to be proportionate, we want it to be effective. We are looking at things like transparency, governance, conflicts, good systems and controls, robust systems and controls. So again, everything, all the ingredients to help support market integrity and support trust in those ratings. One other area that we're looking at, and again, kind of going back to that theme of kind of progressing and things moving on, is TCFD requirements for asset managers. You may have seen that we published a brief summary of a review that we carried out into how those rules have been implemented, and we are now exploring how what that means for kind of the sustainability reporting landscape going forward. We found that firms did find the TCFD rules, particularly at entity level, helpful in terms of supporting those discussions around managing climate risks and opportunities, but there were some challenges, particularly around data, particularly around accessibility to retail investors. So what we're doing now is really trying to engage and build on that review and explore what we might be able to do to support a more streamlined regime going forward, bearing in mind that there is SDR, there's ISSB, so we just want to kind of take everything in the round and really hear your views as well about what might work. So please do come and talk to us about that. And SDR, of course, will continue to support implementation, we'll continue to publish the good and poor practice examples, we'll continue to clarify areas of the regime as needed, and we'll continue to monitor how it's working, listening to feedback. It's really helpful debate about ethical funds earlier. All of that I'm soaking up, and yes, we will continue to see how the regime works and what you want and what you don't want and what clients want and what clients don't want going forward. I've just seen the time, so I will stop talking and hand over to you all for any questions. Oh, Miranda.
Thank you. Do we have any questions?
I think
Miranda.
Stop.
I think when the SDR regime came out, there was a kind of...
Do you want to say it again? Sorry, the mic wasn't picking up.
When the SDR regime came out, I think there was an undertaking to do a review, which I believe is by the end of next year. Can you just give us a little highlight of what we can expect?
So, yes, you are right. So we said we'll carry out a post-implementation review after 3 years. So I think we haven't really scoped out what that review is exactly going to look like yet, or the timings. I think next year would be 3 years after the policy statement, but not necessarily 3 years after the actual regime has kind of taken shape. So yeah, we'll certainly come back to you and with any more information as they're thinking about what that review will entail going forward. But I think we are, while that might be a more formal review, very much still listening, and we'll happy to kind of continue the discussions in between as well. So please do keep talking to us in between.
You said at the start about corporate data being so important and needing to be reliable. You didn't mention timely. I know that could be covered, but I'll give an example. BP, who's obviously changing from back to being an oil and gas firm from renewable leaning. Rathbones challenged them at the AGM, don't know if it was David himself, about the fact that for 2 years in a row they weren't giving out their, I don't know exact title, Sustainability Net Zero report. But given the fact that that change could be making them having to move out of a fund because of the label, how much response are you getting from the corporate side of things to supplying data through?
Yeah, it's a really good question, and timely is obviously key as well. I think at the moment we have the rules that corporates are required to disclose against, so TCFD, and as I mentioned, ISSB, which focuses on annual reporting. But similarly, welcome any feedback once we issue our consultation on ISSB. If you have any further thoughts on reporting frequency and timing, but also kind of any gaps in between as well. So we very much welcome that.
I think we've got time for perhaps one more question. I'm being told we're needing to... So is that Ebru over there? Oh, sorry, gentleman here first, James.
Oh, hi, Louisa. James Cora from CCLA. And just to say thank you so much for the work that you're doing in this area and how open you've been working with asset managers on it. I'm afraid I've got 2 questions, which you might be able to do quite easily. The first is, do you have any reflection on why the financial lives data continues to show strong demand for this type of funds, yet when we talk to people in the street, and as Jen said earlier, we're not seeing those flows come through at the moment? What's the blockage? And the second point is, particularly in relation to the anti-greenwash rule, have you engaged with the outsourced internal audit partners? Have you seen how those particular systems and controls are being put into place?
2 very good questions. So I think Financial Lives survey, just a couple of initial thoughts. I think we saw the kind of cycle that in terms of kind of flows. I think the Financial Lives surveys happen a couple of years before they actually publish, so that might be some one of the reasons for that slight disparity. But I also think, and these are just my personal kind of initial reflections rather than the kind of formal view, is that while the financial survey shows that consumers do want to invest in to do some good, we still need the ecosystem to support that, and SDR was a huge part of that, actually being able to give consumers the information that they can trust and that is clear to them, so that even though they want to do some good, they actually feel confident in actually being able to put their money where they want to. So that's a key part of SDR. And then in terms of the wider ecosystem around auditing, we specifically decided, and I think we explored this in our very early discussion paper on SDR, which feels like absolutely forever ago now. Whether there was a need, yeah, it really is. Whether there was a need for that external verification, and the feedback that we got was that is probably an extra layer of cost that shouldn't be needed, given if the process for the FCA and if the criteria was clear and robust and rigorous. So we don't have any specific audit assurance verification requirements across either SDR or any other disclosure requirements at the moment, but I think we do very much keep an eye on the broader ecosystem, and we'll continue to explore the need going forward.
And my concern on verification was always that the fund managers had been closer, a lot of them being closer to sustainability than a lot of the people who would probably put their hands up to be verifiers ever had been. So there were not risks, but it's not a bad thing. If you want to go for external verification, do, but don't make it a requirement. I think there's a question for Ebru in the middle here, George.
Hi, it's Ebru here. Very quickly, wanted to get your views on FCA's plans with regards to the financial risk that you mentioned. Obviously, there's got to be an amalgamation of metrics with the objectives that the fund managers are aiming for in terms of sustainability. What are FCA's views on metrics that they use? Is there a guideline for fund managers trying to achieve not just sustainability goals, but also risk-adjusted returns, as we were referring to and the panel was referring to earlier? Thank you.
Yeah, that's a really good question. I think that very much is where kind of ISSB comes in. Like, we as the FCA won't necessarily set the metrics, but what's important is that there is that global consistency in that everyone is speaking the same language when it comes to metrics, and that information flows right along the investment chain from listed companies, from corporates to fund managers and ultimately asset owners as well. So I think that's why we very much want to consult on ISSB, and then for that to flow through.
Brilliant. Thank you, Louisa. I think, hopefully, Louisa, if you can you stay at the front for a few minutes after so people can come and talk to you if they've got questions. Obviously, you're welcome to stay here for coffee and lunch and all day if you like, but you've probably got a very busy schedule. Can I ask everyone to please thank Louisa, because I really appreciate you coming here.